Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Hi, everyone. Welcome to the Bloomberg Businessweek Weekend Podcast. Well, we've officially entered the final month of 2024, and with that, the last jobs report of the year that will now weigh on the Fed's rate cut decision later on this month. For the latest on that, head over to Bloomberg.com or check it out on the Bloomberg. Now, Tim and I, we got our own read on the U.S. economy and really the housing economy here in the United States, courtesy of the team over at the asset and real estate investment company, Walton Global. More in just a moment.
Also this week, more records on Wall Street. On that, we have a consistently top-performing fund manager who has returned on average 25% annually over the past 5 years, all by investing in 30 stocks.
You're going to want to take notes on that one. Plus, as the auto industry tries to retool for the electric vehicle era, we see increasingly that road is paved with a few bumps along the way. We saw this past week after the surprise departure of the CEO of Stellantis. Our take on the EV industry came courtesy of the CEO of the EV charging management software company, Drives.
Also from the alt energy space, how to build out nuclear energy in the U.S. with the chief nuclear officer of the nuclear company.
All of that to come. We begin with one often overlooked investment group. Small and mid-cap stocks, they just don't get any respect sometimes, although they get talked about a lot.
Is that your Rodney Dangerfield?
I was going to go there.
Go there.
All right. While all the attention has been focused on large cap tech stocks for good reason, they've really fueled market gains such as NVIDIA. Small caps finally seem to be making up for lost ground, with the Russell 2000 trading near an all-time high, which hit a record about 1 week ago for the first time since 2021.
Ryan Kelly is the chief investment officer and portfolio manager at Hennessy Funds and invests in the small and mid-cap space. He's got a pretty impressive track record to show for it. Ryan co-manages the Hennessy Cornerstone Midcap 30 Fund. Its return on average about 25% annually for the past 5 years, putting the fund in the 98th percentile, so beating pretty much just about everyone in the sector. He stopped by to talk about strategy and picks.
So much of the large cap stocks are just dominated by the Magnificent Seven. Still. And NVIDIA, so far this year, 25% of the S&P's returns have been from NVIDIA. So one stock doing that much good and maybe sometimes that much damage to one particular index is a lot. So we like the small and mid-cap space because it's not as susceptible to a lot of there's not mega caps that'll take over the index. It's trading at a better valuation. Certainly some changes that are supposedly upcoming with less regulation, better corporate tax rate. That's going to benefit some of these companies as well.
Tariff policy?
Tariff policy could actually eat into some of their earnings for some of these mid-cap stocks.
What's of those things you mentioned, what's actually priced in right now in your view? And we'll talk about some of these individual names soon, but the administration is in transition.
Yes.
So we know the makeup of Congress pretty much. Mm-hmm. What do you think they'll be able to get done? So therefore, what is priced in?
It's a very tough question. I would say that tariffs are not completely priced in because I think there's still a disbelief that we can get to some of the levels that have been talked about. I think that personally would be very detrimental to the economy overall. And I hope that sort of more level heads come up with maybe a better plan. Mm-hmm. But if that is the case, we're getting the kind of tariffs we're talking about, that really could hurt, I think, some of the longer-term earnings of some of these companies.
All right, let's get to it, because I want to talk names. Your fund is up 37% year-to-date, 98th percentile. You've had a great 5 years for the fund as well. You pretty much are beating your peers, so kudos. We like to talk to people who perform. Mm-hmm. Your strategy, it's a 1-year rebalance. You reminded me when you sat down here in our studio, you just finished a rebalance. Tell us about that rebalance. There's 30 names, and you said only 2 have stayed in the portfolio from the past year.
Yeah, so what we do is we really want to make sure that we're just going to continue to follow the same formula year in and year out. So this fund is 21 years old. It has been done the exact same way since inception. We use a very disciplined process. That's actually on our website. The formula is listed there on how we do it. But the idea is that once a year, we'll look at all the portfolio, and we'll look at the universe of stocks out there. And
It's a lot to look at.
It's a lot, and so it's a quantitative-based, it's a formula-based fund.
Okay.
But it's based on fundamentals going back for many, many, many decades. When this was first put together, they looked back at 3-4 decades worth of data to see what really works on Wall Street. And so what we do is we look for companies in the 1 to 10 billion market cap range. We look for a low price to sales, which is an interesting metric because most people use PE or EV to EBITDA or whatever. We look for a low price to sales of less than 1.5 times.
So it almost thinks about some valuation that hasn't been recognized, right, as a result.
A lot of times
of the top line.
You'll get companies that are in a bad part of the cycle, or that are underperforming, that are about to turn. And the reason why we're okay doing that is that another important part of the metrics is we're looking for momentum. So we already want stocks that have turned. We don't want to buy a undervalued company that has a lot more to go on the downside, but rather buy a company that's a good company, that's out of favor, that's on its way up.
So one of your old holdings, that was one of your biggest holdings, was Sprouts Farmers Market, up to like 200% year to date. It's trading near an all-time high. You said bye-bye?
Yes, so that in this most recent rebalance, it then moved way above our price to sales of 1.5 times. Only about a third of companies out there that are publicly traded trade below 1.5 times, so it's a pretty restrictive number. And that went way above it. It performed very well for us, but now it's gone.
Okay, let's talk about some of the names that you're adding.
Yeah.
One name that I think a lot of people would be surprised to hear would be Peloton.
Yes.
This is a company that has faced incredible pressure since the pandemic.
Yeah.
Why are you optimistic? Why are you bullish?
It comes down to the formula first and foremost. It fits. It trades at 0.7 times price to sales. We bought it around, we were buying it around the $5 to $6 mark. It's now approaching $8. So it has had a bounce back. They're starting to improve on their cost side. A new CEO is always an important and potentially beneficial. It's certainly challenging, but we've seen that type of turnaround before. Believe it or not, Crocs. We owned Crocs when nobody wanted Crocs, and now all my children wear them. We owned Restoration Hardware when people were not going. Nobody's going to go to a store anymore.
Yeah, that's what you have.
And then
like
they became. It was an incredible turnaround story. So there's a lot of. It may not come down to this particular name working the best, but it's just a representative holding of what we'll own. And the idea is, you'll get something that's completely out of favor, that's beat down, that maybe has a second life.
Tell us about Herc.
So Herc Holdings is, when we did the rebalance this year, we did find that there was a whole lot of consumer discretionary and a whole lot of industrials. And Herc is an equipment rental company, essentially.
Okay.
So
ticker is HRI, and it's up about 45% this year?
Mm-hmm.
Cool.
So that, this is typically what we do. We catch something as it's already gone up. We don't want to try to buy it on its way down.
Yeah.
And with the idea
You're okay that you've lost some of the momentum.
We're okay. We'd rather not try to time the bottom, but participate once it turns.
Are you using AI at all now in your analysis?
No AI. This is...
Wait, you're not?
I have to say this is so simple that it's almost too so. And I come from an analyst background where I had to know.
You know, for the last year and a half, that's all we talk about is AI. But go ahead.
I came from a background where I covered banks. I didn't know how old the CEO was, where he went to, where they went to play golf. All these kind of intricate pieces of data. But this is really, it's fundamental quant is what it's called. And the idea is you really just want to boil it down to very simple metrics and just stay with it year in and year out. And it's worked.
Tim, if you don't know, loves to eat a lot. He just finished a sandwich.
It's still got some left if you want some.
It'll come up. Brinker International is another name that you like. EAT is the ticker. Love that. It's up 183%, but you've got it in the portfolio for the coming year. So there's more momentum to the upside.
Yeah, so EAT, Chili's is the name brand. Also Cheesecake Factory. Both of those are two restaurants that are now in the portfolio. Again, it's the same sort of situation we've looked for all these companies.
Cake is up 33% this year.
Mm-hmm. And you look at these names that we add in, and an example that worked really well is Super Microcomputers we owned, and we owned it as it went completely up until it didn't, and we actually got rid of it because it was too expensive. So
who needs AI? We just need Ryan Kelly. Ryan, good to see you with you. Have a great holiday season. He is the Chief Investment Officer at Hennessy Funds.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business App. Or watch us live on YouTube.
From a model portfolio to modeling what is going on in the U.S. housing market. U.S. Census Bureau and Department of Housing and Urban Development data show that sales of new homes in the U.S. slumped in October to the lowest in almost 2 years, as 2 hurricanes hit the South and affordability challenges continued to weigh on buyers.
On top of that, new single-family home sales decreased 17% last month to a 610,000 annualized rate. The median estimate of economists surveyed by Bloomberg called for 725,000. Meantime, home price gains in the U.S. slowed in September as buyers gain more negotiating power in the housing market.
Katie Hubbard has a front seat to the housing market. She is the executive VP of capital markets of the privately owned asset and real estate investment company Walton Global, which has nearly $4.4 billion of land under management and over 90,000 acres under management in the United States. The company operates in the retail, industrial, and commercial sectors.
Our clients are typically the largest public home builders, and the rate environment obviously is affecting all of the home builders, but the large ones that have the scale and the ability to buy down rates have been doing just that and been gaining market share in a rising rate environment. It's been good for the large home builders who are more competitive.
So it's okay. That's what's hard to understand, because the idea is when rates go down, people can afford to buy more homes. Hopefully, that's the idea. We haven't really seen that play out necessarily, just because of the supply and demand element here, but how does it affect the way that home builders then come to you to purchase land?
Yeah, it definitely, just because we're typically feeding the land to the largest public home builders and they're less rate sensitive. The smaller builders that don't have the ability to buy down the rates are more effective and can't really compete in the land space as well as the large builders. We're also purchasing land ahead of needing it right now, so they're keeping it off balance sheet, where smaller builders who are also affected by the mortgages, they don't have the ability to land bank like the larger competitors do. But obviously when rates go down, in that sweet spot, when it goes below 6%, there's a lot of people on the sidelines right now that are waiting for that. And we think that that's going to be coming up into the next year. Probably won't be hitting below 6% this year, but next year could get a lot of consumers off the sidelines.
Katie, one thing I'm curious about, and I want to get your take on this, and we want to get into kind of what people want in homes going forward. I don't know if the mega mansion or the McMansions are gone, but before we do that, we talk about the housing shortages in the United States. It's not just a 1 or 2 or 3 year thing. It's at least 10 years, if not more, and that you don't have affordable housing in great cities, be it New York or elsewhere, for those people who work in the city but can't afford to live there. So it's not just about building housing, but building housing, affordable housing, where it needs to be. So when you guys are acquiring land, is it in major cities? Is it suburbs? Is it really feeding the demand that needs to be met?
Yeah, good question. So it's regionally based, but we are typically on the outskirts of the cities where home builders can build larger scale communities versus those infill locations, because we're dealing on a larger scale land supply. But yeah, absolutely, the home builders have adjusted the type of product mixes that they're building to just for that affordability factor. They're building more efficient floor plans. Everything is getting smaller kitchens, smaller garages, smaller storage to build a smaller home just to make it more affordable. And they're doing higher density, to your point, Carol, less McMansions and more amenities geared towards the people that are able to purchase the homes. So you're seeing more pickleball courts out there.
That's kind of funny. What's considered affordable? What do you guys consider affordable housing?
And so the average new home is just hitting around the $467,000 range. And people are moving to the Northeast now for affordability. You can, Youngstown, Ohio, you can get a house for $171,000. It's one of the most affordable markets. And then they're going to where their jobs are located. So, for example, Syracuse, New York has a huge influx of people because Micron's building a $100 billion chip manufacturing plant. So if the jobs are there, then, it's relative to that market. But Southern California, it's still one of the most expensive markets and one of the most difficult places to build because land is so expensive. So it is very relative, like you said.
Well, that said, you do have quite a few assets in the state of California, quite a few in the San Diego area, a few in the Bay Area as well. What is attractive to you about that area, given how expensive it is and how difficult it is for some home builders to actually build in California?
Doesn't scream affordable to me.
Right? It's the overall fundamentals of people wanting to be in Southern California. So the demand is there, and you have a scarcity of land that's available for development. You used to have this mentality of, people didn't want things built in their backyard, the NIMBY mentality. Well, in California, it goes a step further. It's now called the banana mentality, which is build absolutely nothing anywhere near anything. So it makes it more
heard that before.
Have you?
For land.
No, I've never heard that. That's the banana, build absolutely nothing anywhere near anything?
Exactly.
Okay.
And that
can
be the California mentality. And so if you have the expertise and the boots on the ground to buy the land for the builders, the demand for people wanting to live there is there.
Nuts.
Wow.
Looking at the map of your website in terms of where you guys, I guess, have land and land assets, specifically Atlanta, is it still on fire for you guys, or is that property land just sitting kind of empty and demand has cooled?
There definitely is demand there, but you are seeing less demand in the South. Like I mentioned, the October numbers for the Southeast were down, but I mean, it's still a good place for migration for the affordability factor.
Texas too? Are people still flocking?
Texas continues to be a stronghold. Almost all of the top public builders have a very large presence in Texas, but we're moving to places in the Northeast like Delaware, where the public builders have told us they will take all of the land that we can bring them in a place like Delaware, because you've got low property taxes, no Social Security income tax, strong employment, great schools, and the surrounding cities are just much more expensive.
You basically, in 30 seconds, just tell us, you basically have no assets in the sort of northwest quadrant of the United States. I mean, all the way from Iowa to Washington and Oregon. Why is that?
We're going to be expanding our acquisition strategy. So we're going to be entering the Idaho market. We do land bank for D.R. Horton in the Northwest. So we do have some assets holding land off balance sheet for them. So those are markets that we're exploring.
Where's the most expensive place to buy land right now? Just 10 seconds.
Southern California. I mean, California markets are the most expensive and the most difficult.
Hey, that sun is going to, perfect weather is going to cost you, Carol Massar.
Of course it does.
Pacific Ocean's expensive.
Yeah.
Katie Hubbard, thank you so much. Executive Vice President of Capital Markets at the privately owned asset and real estate investment company, Walton Global.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business App, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This past week, news that General Motors is selling its stake in an electric vehicle battery plant in Lansing, Michigan, to South Korean partner LG Energy Solution, recouping about $1 billion in investment from a facility that will still supply energy cells to the automaker's EVs.
The move reflects a realization by the car maker that its battery cell plants in Ohio and Tennessee, along with some supplies from the new plant in Lansing, will be enough to meet near-term demand for EVs without additional capital investment. GM continues to grow EV sales, but a slowdown in demand and political uncertainty over the future of federal EV tax credits have made the future prospects for all electric vehicles less certain.
And the push to accelerate EV adoption in the U.S. is experiencing a massive roadblock, and that is the lack of charging infrastructure. In 2021, the Biden administration announced it would invest $7.5 billion toward charging infrastructure, with the aim of building 500,000 electric vehicle chargers by 2030.
That move could experience an even bigger roadblock if President-elect Trump follows through on his campaign promise to scrap incentives for EV adoption, like the Biden administration's National Electric Vehicle Infrastructure Program and the $7,500 federal EV tax credit. California Governor Gavin Newsom is already preparing for a showdown with Donald Trump over the subsidy.
One company that was recently recognized as a leader in worldwide electric vehicle charging management solutions is Drives. Drives is part of the $5.8 billion market cap publicly held company, Vontier Corporation. Drive CEO is Andy Bennett.
In general, we think about batteries in two ways, right? Of course, there's the batteries that are in the car, right? So you have a battery management system that optimizes the use of that energy. But batteries are becoming more and more important for EV charging. In places like the United States, you have lots and lots of areas that effectively are constrained from an energy perspective. And so you can put large batteries in those areas. You can control the flow of energy, so you can increase the number of cars you can charge. So batteries, when you're thinking about EV charging, there's really two parts of the equation. The first is that battery in the car, how it's behaving, how it's being utilized. And then those batteries that are going to be at gas stations all around the country, they're going to give us extra capacity to really keep that charging experience as quick as possible.
So, okay. So I'm just curious about, it's interesting. I'm listening to you talk and I'm thinking about when we talk about the EV world, Andy, a lot of what comes up is about range anxiety or people being able to find a place to recharge. If I pop on a highway out to Connecticut, I see them, the rest stops, they all have them. But in New York City, it's still really challenging. So I understand what you guys are doing, but I feel like, is this the cart before the horse in terms of having enough places just where people can charge before we kind of take it to the optimization level, which sounds like what you guys are doing?
Yeah, no, we do a little bit of both. So we build the software behind the world's largest charge point operators. We call them CPOs. So think about EVgo as a great example, or Shell. And that software is looking after the health of all those chargers out there. Is the network working? Is it running? Energy is just one part of that total equation. Are you able to bill? Are you able to show up to a charger and actually, use your credit card to go make that work? So without that, without that fundamental software, there is no charging, right? It's the infrastructure software that makes it work. But you're absolutely right. When you think about the frustration that folks have today, it kind of comes in two sort of flavors. The first is, when I get to a charger, is it available, right? And then if it's available, is everything working? And as we've seen in the last couple of years, reliability is going up and up and up and up, which is great. But then you nailed it. The second part is we just don't have enough charging today in place, enough public charging. So if you think about the United States, today we have roughly, let's say, about 200,000 available chargers to people. Most of those are what we call AC chargers. So they're a lot slower than the DC fast chargers that you might see on the highway. And if we were to keep up with really just the current sales that we have in EVs right now, by the end of next year, we would still need to build 4 times more charging infrastructure in the United States to meet that demand. Some of those projections say by 2027, 2028, we would need to build 8 times more than what we currently have, just to satisfy that, what you just mentioned, of course, which is range anxiety.
So a Trump administration, are we going to then ramp up the building of these? Because it does sound like we need them. Like, what are your expectations around policies in the EV world and what it means for the industry and your business?
Yeah, I mean, look, it clearly there's some headwinds with some of the administrative changes. Some of the things that could be changed is, we could get a drop in passenger EV adoption, right? So if we don't have, the incentives, then some folks just aren't going to go buy those cars. Now, having said that, for a company like ourselves that is building the software for the charge point operators, there's still such a huge gap between having enough of those chargers out there to deal with the current requirements, versus what's actually there, that we kind of, some of us in the industry are happy to kind of get a little bit of a catch-up time there. So no doubt, I think if you think about, right now, where are we in terms of charging infrastructure growth for the year? Most of the projections at the beginning of the year said, look, we'll probably end up at around 30% year-over-year growth in public charging. We actually know it's probably closer to 36 or 38% growth. It's just an incredible CAGR. Right, think about that. That's a massive amount of infrastructure that big CPOs are building as quickly as they can. And I think often we spend a little bit too much time maybe associating that build out with the NEVI funding, the federal funding that came out. Most of that infrastructure spending happened way before the federal government ever started to step in and incentivize. So look, we still have a ton of demand. The big CPOs are still building at just breakneck speed. That's going to happen. It may get a little bit compressed, of course, but it's still going to happen at a very, very fast rate, independent of the whole NEVI funding pathway.
I'm wondering about just a basic question, Andy. If we think about where all the gas stations are in this country, why is it cost prohibitive for these gas station owners to just add one or two EV charging systems to their existing gas stations? Like, why is this so difficult to do?
Yeah, Tim, that's a really great question. For me, I kind of to look for that answer, one of the best places to go look is in the Nordics, right? Where we know today over 90% of all new cars are EVs. You look at the UK, you look at Europe, which is, by the way, one of the places my company has been for years helping charge point operators. What you see is some gas stations are really well suited for electrification, and some aren't. Maybe a couple quick comments about that, because no matter what, we believe that the winners in this marketplace are going to be the fueling stations that also have other things, other amenities, other conveniences. So when you're in Oslo or you're outside of Oslo, whether you're in the urban area or you're on the highways, what you see is EV charging stations that have outdoor gyms, they have incredible food, clean bathrooms, really nice amenities. The second you show up at one of these stations, you connect to their Wi-Fi, and you start to get coupons to go inside and save 10% on a cup of coffee. It's a really, really integrated experience. And we certainly see some of the larger retailers here in the United States starting down that pathway. Apple Green, if you've ever driven on Route 95, is a perfect example as you go through New Jersey. Extremely innovative around what that experience will look like. But having said that, some of those places just aren't great spots, right? They may not have the ability they might not have just the real estate to bring that in. They may not have the conveniences. And remember, the average wait time is probably about 22 minutes today as you're charging on a DC fast charger. So you generally want to get out of the car. You're going to expect other amenities. But when you go back to the European example, what we do see, especially in the urban environments, is a slower, more methodical transfer. So over time, they don't just go 100% electric at those stations. They may have 10 fueling pumps and 2 DC chargers to start with, and then they slowly pull out those pumping stations. Circle K is a great example in Europe, where they have done this really fluid transition as the economics make sense. That DC fast charger is expensive, so just the way to think about it is break even on that investment. Probably close to about 11% utilization, right? It has to be being used 11% of the time that it's there.
I will say, Carol, my trip to Norway a few years ago, the infrastructure just makes you cry when you compare it to U.S. infrastructure. The tunnels are incredible. Just drill right through these mountains, miles long, totally well lit, not crowded at all. Unbelievable.
Maybe Elon's onto something with the Boring Company.
Not yet.
Just saying.
Not yet.
Hey, just got 30 seconds, Andy. In a nutshell, or a word or two, how do you describe the EV market today?
Look, we make software behind these charging companies. We can barely keep up with the demand, and the growth that's taking place has been incredible. We're a company that's doubling year over year, and just building the things these folks need to be successful. For us, a huge portion of the market still remains in Europe. The United States is just starting to grow.
Yeah.
I think we're going to see a little bit of a dent taken out of passenger EV charging. Nothing is going to stop the electrification of large-scale fleets, though. That is picking up at a pace that is really fantastic. And why that's relevant is, as that continues to be successful, we're going to see, whether it's a passenger or a truck, co-charging at these different places. So the infrastructure is going to continue to roll out. At the end of the day, if you build a car, right, there's two things you can do to go get people to buy an EV car.
Right.
Cut the cost of the battery and get more EV infrastructure out there.
Totally makes sense. Andy Bennett, really enjoyed this, CEO of Drives, joining us right here on Bloomberg Business
That's
Week.
DRIIVZ.
Very cool.
Yeah.
I love that.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business App. Or watch us live on YouTube.
Last month, our Bloomberg News colleague Jennifer DeLuey reported that the Biden administration is setting out plans for the United States to triple nuclear power capacity by 2050, with demand climbing for the technology as a round-the-clock source of carbon-free power.
Under a roadmap being unveiled a few weeks ago, the U.S. would deploy an additional 200 gigawatts of nuclear energy capacity by mid-century through the construction of new reactors, plant restarts, and upgrades to existing facilities. In the short term, the White House aims to have 35 gigawatts of new capacity operating in just over a decade. For a little bit of context, nuclear accounted for about 100 gigawatts of installed electricity generation capacity in the U.S. That was in 2023, so this would be a big jump.
Joe Kletch is hoping to help the U.S. get there. He's chief nuclear officer of the nuclear company, which is looking to build a series of nuclear power plants across the United States.
We aim to really develop and deploy new nuclear at large scale. We're aiming to help deliver in a way that we've never seen before, which is bringing clean, firm, sustainable power to the grid that will help solve some of the issues we're going to see with the growth of AI, the growth of electrification related to vehicles and manufacturing. And we believe that doing new nuclear construction in a way that is designed once, rinse and repeat many times at scale will get us into a position where we can really drive down the costs and create a product that is much needed for national security, frankly.
How do you do this? And you can answer this question in a way that other people can't, because you worked at Southern Company as operations director for the Vogtle Units 1 and 2, and then you also transitioned to oversee Vogtle Units 3 and 4. So these are very expensive. They took years, decades. They were billions of dollars over budget. How do you not repeat that at the nuclear company? Like, how are you going to do that differently?
Yeah, I think it's a great question. I get asked this question a lot. And yes, my career started in the U.S. Navy as a submariner working on nuclear submarines. And I've progressed through many utilities operating and maintaining nuclear facilities. And as you mentioned, had the great opportunity to help with the Vogtle project, which was a monumental effort by Southern Company. Many lessons learned. The simplest way to help people understand this was a first-of-a-kind build in our country with a first-of-a-kind technology. We need to continue to use the lessons learned from projects like Vogtle and many others that have occurred around the world to move us from a first-of-a-kind project into what we call nth-of-a-kind. So we got to get through the early stages of capturing lessons learned on what is a really, really great design, and there's many others out there. You continue to use this same design, use those lessons learned. We think we can get 40% efficiencies through lessons learned. We also believe there's 20 to 30% savings in the use of digital technologies, whether those be digital twins, 3D scans, drones, other technologies that are available today that weren't necessarily available when these nuclear projects were occurring in the past. That is our path to really getting the costs of nuclear down, and getting it in a position where it can provide what a lot of other forms of energy cannot provide, and that's the security to the grid to provide that firm 93% plus capacity factor of clean energy.
The plants that were started by Southern Company, I just want to go back to, right? Considered a milestone in U.S. nuclear power construction, but they were 7 years later than originally planned, and a budget of more than double the preliminary projected cost of over $30 billion. I would assume making nuclear power plants is difficult. Forgive my sarcasm, but we know that this is not it. And Tim and I were talking before we got going. I had a dad who's an engineer who worked in the early space program and putting men on the moon and guidance systems, and the system of government contracts of low-cost provider often being at the top of the list as a priority makes me a little hinky when we're talking about nuclear power. How do we get it right? How do we do it safely? How do we do it without the cost overruns?
Yeah, so I think those are all great points, and they're obviously they're problems that we are trying to solve at the nuclear company, and I believe we will solve. Again, the number one thing is let's design a technology that works extremely well, and let's continue to rebuild that technology many times so we can really capture the lessons learned and then get the cost benefits out of capturing those lessons learned.
Joe, what is the different technology from maybe what was done by the Southern Company versus what you guys are looking to do? Break it down for us.
Yeah, so we are not a technology provider. We are a developer and we are a deployer. So we're gonna develop these projects, whether related to where they're going to be sited, which partners we're going to work with, and then we have the team that's going to come in and perform the project management and deployment to get these from the numbers that you estimated down to half of what those have historically been through what I said before, the use of technologies, getting the right systems in place, locking that design down. Remember, when you're doing a first-of-a-kind project, there are a lot of lessons that come out of that. And if you don't capture those lessons and continue to do it, then you've just thrown away all the value you get out of doing a technology. It'd be like if Henry Ford developed the Model T, built one, and said that was way too hard to do, I'm not going to build any more. You got to keep iterating on that process to get it to a point that you get to the nth-of-a-kind cost on these technologies.
It's a very capital-intensive process, to say the least, building a nuclear power plant. In terms of where your role is and just where the money is coming from, give everyone an update on, you guys are a startup, but give everyone an update on how much you've raised and how you think you'll be able to get there.
Yeah, so we have investors on the company side, specific to the nuclear company, that are investing to really fund our company. We'll continue through the process of a startup company to do our rounds of funding as needed. Specific to projects, we leverage public-private partnerships, and then we'll be pulling in different investors associated with the public-private investor partnerships to drive the funding of the projects themselves. So we plan to roll out more information in the first quarter of next year related to where that funding is coming from and who those potential partners are. But for now, we don't want to share any more detailed information.
Can you tell us where some of the projects you're looking at would go?
Yeah, at a high level, our theory is we're going to focus on projects that we can build quickly. We believe we need to be building now. We don't need to be waiting on technologies. There's technologies available that can be built now. So with that said, we are looking at sites, and we have an algorithm that helps with our site selection process that focuses on sites that already have some form of licensing and environmental work already completed, so we could start these projects sooner rather than later.
So, Joe, help me understand something. So, as you said, you're a project management company. You're not a technology company. So you're not actually building them. It's like you're a middleman, it sounds like, right, in terms of getting these done. Why do we need a middleman? Won't it just ultimately come through the government or utilities or states or power companies figuring it out? Why do we need a middleman? Is this more of an investor play? Which is certainly of interest to the Bloomberg audience, who are always looking for different ways of investing. But is that what this is mostly about?
Yeah, I would say we're more of an orchestrator than a middleman. We certainly want to work the front end from an investment perspective and a financial perspective to make sure there's models where large utilities don't have to take this capital risk all on their balance sheet. So that's part of the problem we're solving. But we've also pulled together a team of experts that have built these projects recently in the United States and elsewhere, that we're building the best project management team around to be able to go and really help the utilities and partner through our consortium to drive down these costs quicker. What we've seen in the past, in the 70s and 80s, when these facilities were being built, every utility would go about this on their own, and they'd all want to do it a different way. So you never truly got to that nth-of-a-kind cost. We believe by using our consortium of utilities, OEMs, hyperscalers, we can bring more power to this, and we can really use the rinse and repeat method to drive these costs down quicker.
No, I kind of understand the model. But let me just ask you then, who takes the capital risk and who actually takes the responsibility of making sure that it's a safe plant ultimately?
Yeah, so again, public-private partnerships. So we'll be working with the government on part of the capital risk. We'll also be focusing with our investors to take on that capital risk, so it's not put directly onto utilities or rate base, with more of a build transfer model, if you will. As far as who controls the safety, the licensee
hang on a
role.
second. So does that also mean that taxpayer risk? If the government's involved, it's also taxpayer risk, right? Potentially.
Yeah, it could be. Now, again, we'll release more information on the actual programs we're looking to use in the first quarter of next year, but I'll just leave it at public-private partnerships for now.
And then the safety aspect? Yeah, go ahead.
Yeah, the safety aspect. So part of our consortium is going to be large utilities that have historically operated these facilities for years. They would be the licensee and the ultimate owner of these projects once the build is complete.
Is this a model, just 25 seconds, that really is for the U.S.? Or, I mean, where Europe and elsewhere outside the U.S. are already kind of all in on nuclear? Is that part of it? And forgive me, I only got about 20 seconds here.
Yeah, I'll be quick. So we initially, we're building this company to help support the U.S. market, but we are receiving a lot of interest overseas with all of the new nuclear projects going on there, and there's a lot of help needed in those areas.
Interesting stuff. Stay in touch as you can share more with us. Joe Kletcha, Chief Nuclear Officer of the nuclear company.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business App, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Plenty ahead in our second hour of the weekend edition of Bloomberg Businessweek, including America's favorite food group, a patty and 2 buns with some stuff thrown on top. From humble backyard barbecues to Michelin-starred menus, why the hamburger continues to thrive with American consumers, really global consumers.
Plus, the 12 Days of Christmas may need a 13th verse about my true love going broke because of Christmas gifts. Carol, they're actually getting pretty expensive. And it's not because of,
gold rings.
Yeah, this is so confusing. It's fine. It's fine. I'm not bitter about it.
He is a little bit. We'll explain later on. First up this hour, as many of us gathered with family around a table filled with trays of food for Thanksgiving, millions of Americans worry about where their next meal will come from. In 2023, about 13.5% of households in the U.S., that's about 18 million people, were food insecure. This is according to the USDA, which defines food insecurity as, quote, at times during the year, these households were uncertain of having or unable to acquire enough food to meet the needs of all their members because they had insufficient money or other resources for food.
The picture is actually worse for households with children, where nearly 18% were affected by food insecurity. And it's something that Claire Fontenot is all too familiar with. She's the CEO of Feeding America. It's the U.S.-based nonprofit that has a network of more than 200 food banks. Last year, Feeding America distributed more than 5 billion meals. So are things actually getting better?
Unfortunately, things are worse. I know that might be difficult for any of us to wrap our heads around, but it's true. Food insecurity rates were lower during the peak of the pandemic than they are today. They're at their highest rates since the 2008-2009 economic downturn.
Why is that?
Well, in part because food insecurity captured the attention of the American public and policymakers during the pandemic. People saw those very long lines of cars on the road or saw parking lots filled with 10,000 cars, each car representing 4 to 5 families, and it got our attention. And when we are intent on something, we tend to do something about it. So a lot of resources were directed toward food insecurity during that time. Since then, the lines have simply returned to the insides of buildings, but I think people think they've gone away. That makes opportunities like this one all the more important for the people that I sign up to serve every day.
Claire, why, though, are people hungry in America? We're a rich nation. And I guess I wonder why that exists still.
Yeah, so that's a really complex question with complex answers and nuanced answers. But I will tell you one thing as an example. The largest or the fastest growing population of people who are showing up at food banks are people who do not currently qualify for any federal nutrition programs. So SNAP, formerly known as food stamps, they can't get SNAP. We have systems in the country that simply don't work well. They don't think about how each could relate to each other and how sometimes they perpetuate people staying down. We talk about it a lot. It's sometimes characterized, for instance, as benefits cliffs, where it happens all the time throughout the country that a person might get a $1 an hour raise and lose all of their child care benefits, or put away an extra $100 in the bank, and now they no longer qualify for their housing.
Right.
So it's a combination of things, and I'm hopeful that the Trump administration is going to sit down and bring in all of the different parts of the government, bring them together and have them work together to come up with some effective solutions.
We talk about margins a lot here, certainly when it comes to like an earnings or balance sheet on a company. But I just think about the slim margin or no margin that so many American families are trying to exist or, and live on. And it's just too fragile.
Claire, I was thinking as I was preparing for this segment, I mentioned USDA data at the top. About 13.5% of households in the U.S., 18 million homes were food insecure in 2023. This data come from the USDA's Economic Research Service. And I was thinking to myself, is this how valuable this information is, because it gives us sort of a place to start our conversation with you, but also it's important to people like you because it gives you a baseline of how to understand food insecurity in this country. We also know that the Trump administration, the incoming Trump administration, wants to cut $2 trillion from the federal budget. I'm wondering if you think programs such as these, important economic research service data or other programs at the USDA are at risk as a result of the new administration incoming?
Well, I certainly hope not. And I wish I had a crystal ball, but I don't. What I can say is that Feeding America's Network has been successful in working with every administration since our inception. We worked with the Trump administration during trade mitigation, for instance, that incredibly nutritious food that was being produced by U.S. farmers, growers, and producers. So much of it was actually sent into the charitable food system where people received more access to nutrition than they ever have. We have worked vigilantly as a network to make certain that we maintain a status of being nonpartisan, not bipartisan, which I say reduces you to the lowest common denominator, but nonpartisan. We stand with people experiencing hunger. They tell us what they need. And when we get them what they need, communities thrive. When communities thrive, businesses thrive, the whole country thrives. And it's simply not possible for people if they don't have enough food at home. It has a negative impact on everything that we value. And when they get what they need, it has a positive impact on everything that we value. So we're hopeful that we're going to continue to be able to get people to work across whatever those divides are that we've created between us and work with us as we work in communities across the country.
So Claire, I think it's pretty honorable what you guys are doing and have been doing for years. Personally, I'd like to put you out of business, and I would love to see no American go hungry. So tell me, what is the root cause of why Americans are hungry in America today? Is it, and help me fill out the picture here. Is it people that you are providing assistance for 1, 2, 3, 4, 5 years? Are they often getting assistance for a long time? Is it because they can't get a job that pays? Is it because they're a mom with kids and raising young kids? Like, what is it? Why do we go hungry in America today?
Yeah, it's all of the above. So there are a group of people who come to us and it's just episodic. They had a big medical expense that they had difficulty addressing, and we're there to be helpful in that moment of crisis. There are others who have come to us because they're in college. I, for instance, was food insecure when I was in college. I had to turn to the very system that I'm so privileged that I get the chance to help lead. And for me, it was during a period of transition when I was working really hard to create a different kind of path for myself. My parents hadn't had the chance to graduate high school, and here I was in college, and I wanted to make good, and I just couldn't make ends meet. So there was a lot of college hunger in the country, and there also is generational hunger in this country. People who turn to us every year and who have for many generations turned to the charitable food system. We've asked them, so what is it that puts you in that line? And they've been answering. We file a report every year in September, which is Hunger Action Month. It's called Elevating Voices to End Hunger Together. And it's where people experiencing hunger tell us why they're in the line. So here's what they tell us. They say it's because of things like housing that's not affordable, is because they don't have access to great health care, and they care about their health. It's because of things like the benefits cliff, which I alluded to in the earlier segment, where when they start getting ahead, the system actually pulls them backwards. So it's a lot of things. And we, as Feeding America, we know that to solve hunger, we can't simply food bank our way out of it. So like you, we want to put ourselves out of business. And the way to do it is to be comprehensive and thoughtful and nonpartisan and do what's best for the whole country by lifting people up who are experiencing hunger.
Claire, Carol and I were talking just a few moments ago and sort of asking the question of supporting a charity such as yours versus working closer to our own communities. How do you communicate that to people, supporting Feeding America versus supporting a food bank in your hometown?
What's so beautiful is there is no versus. Feeding America is a national infrastructure, but it is an intensely local organization. Those food banks are in local communities. If anyone listening and watching were to go to feedingamerica.org, all that you'd have to do is type in the zip code for the community you care about the most. And there is a member of the Feeding America network that's serving that very community. Having a national infrastructure allows us to have a lens, a pulse, if you will, on where the greatest needs are, where the hot spots are. We provide funding to food banks and pantries. Again, there are over 60,000 agency partners for Feeding America. Some of them are big, some are medium-sized, and some of them are little bitty church pantries throughout the country, especially in rural America, where without those church pantries, there's so many people who would be devastated because of the implications of hunger. So with Feeding America, you don't have to make a choice. Choose local. That's what we want you to do. We want you to support your local community. And what we do as a national organization is put you in the best position to be able to do that.
All right. So appreciate getting some time with you as we get ready for the holiday season. And we know it'll be a season that is going to be tough for a lot of Americans. So appreciate checking in with you. Claire, happy holidays and nice to talk with you again. Claire Babineau-Fontenot, CEO of Feeding America, joining us there in New Orleans. I was just looking for my local zip code, two food pantries that are not at all affiliated. Like they don't have Feeding America branding at all. But are they affiliated? Yeah, City Harvest is one of them. Very prominent one here in New York City. Probably makes sense. I was looking at the list of partners. It's a who's who of those in the food industry. And so they probably work together in filling that out. All right, you're listening and watching Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business App. Or watch us live on YouTube.
Here's the beat. Americans, we all love hamburgers. According to a USDA study from 2020, Americans consume an average of 2.4. No, that's not true. 2.4 burgers per day. That's not true. Oh my God. I can't tell you how much we've debated over this statistic this week. No, Americans consume the equivalent of meat that would add up to 2.4 burgers per day if they were just hamburgers. But that stat includes all meat. Anyway, it's about 50 billion burgers per year. I'm just going to say we eat a lot of burgers. Can we just... The numbers don't make any sense here. Yeah, I got a lot of beef with this, okay? Funny. Here's some more juicy facts that won't make your mouth water. When it comes to costs, in the second quarter of 2024, the average price of a fast food restaurant burger was $8.41, up 16% from 5 years ago. Even at McDonald's, the average price of a Big Mac, we're talking no fries, no drink, just the sandwich, back in June, it was $5.29. That's a 21% increase from 2019. That's a lot. And you got to get the fries because that's why you go to McDonald's. I'm just going to put that out there. Hey, someone who watches beef prices closely is Pat Conlon. He's the president of Wayback Burgers, the fast casual chain that, yes, specializes in burgers, fries, shakes, and a lot more. They've got about 150 locations in the United States, another 20 in countries, including South Africa, Japan, Canada, and elsewhere.
We play in the fast casual segment. In the
so
better,
the Shake Shack
burger. Shake Shack, Five Guys.
Okay.
We're still waiting in Manhattan, I'm just telling you.
Yep. Very soon. You won't have to wait much longer. We're going to open up our first Wayback restaurant in Manhattan on 7th Avenue and 27th Street. Should be in January, right across from FIT. So then you'll be able to get one of those 2.4 burgers per day.
I don't know know what that means. I'll have to double check on that. But talk fast casual, because, we talk about Chipotle, who is often credited with really creating it many years ago in terms of fast casual. It wasn't just the fast food places that we got accustomed to. It was a little bit of an experience.
Right. When I grew up, it was really fast food, and now fast food's called QSR, quick service restaurants.
Yeah.
Fast casual started really with Chipotle, Panera Bread, higher quality, elevated food, elevated experience in the restaurant. More fresh. People wanted a better quality burger, better quality salad to go to, and they're willing to pay more for that quality, but also for the overall experience and the atmosphere of the restaurants.
How do you replicate that atmosphere of the restaurant in New York, where rent is super high, spaces are small, and crowds are aplenty?
You have to be fast. So even though we do the order, we don't pre-cook any burgers. We make the burger when you order it at the point of sale system. But it's really, nowadays, the digital ordering process is a big portion of our business. So people ordering ahead on the app.
How much of your business
online.
is that?
It's about between the app and online ordering and delivery. It's about 40% of our business is digital orders.
How much is that up just in the last few years?
Online, app, and delivery are 40% of the business.
Correct.
Okay, forgive me. Go ahead.
And when you do delivery, are you doing third-party delivery?
Third party through Uber Eats, Grubhub, DoorDash.
Do you hate that and paying all those fees? Can I just put it out there?
We pay the fees.
I know, but
both of us pay the fees.
Yeah.
The restaurateur pays commissions to those services, but we don't. I mean, if you had to start a delivery service of your own, there's a cost involved in that as a restaurateur. Delivery guys, insurance, cars, things like that. So there is a value to having them, and they bring certain guests to, maybe not to the restaurant, but they bring those sales into the restaurant, because there are certain people that are only going to order delivery. Mm-hmm. And when I was a kid, the only thing you could get on delivery was Chinese food or pizza. Now you can get everything under the sun.
It is so true, right? In terms of diversity. I have to say something. Excuse me as I blow my nose. Sorry, I'm getting cold. Five Guys, In-N-Out, Wayback Burger, Smash Burger, Burgerville, Fat Burger, Johnny Rockets, Whataburger, Red Robin's, Hardee's, Jack in the Box, Wendy's.
Well, now you're getting to some fast food.
Okay, but I'm just going to say, there are so many burger joints out there. How do you, I understand fast casual and experience, but how do you stand out? Like, what's your fear about coming into a New York market when I can also go to PJ Clark's and get a burger with béarnaise and be at like kind of an old speakeasy and have a really cool experience? But tell me how you do it.
Well, it has to be done, I mean, in the fast casual segment, and even in the QSR, quick service restaurant service now, quality, everybody has quality food. Okay, so
everybody does not have quality food. But go ahead.
Everybody has some semblance of quality, or people expect.
She'll fact check you.
People expect quality for the level of price they're paying.
Yeah. Okay. Fair.
So you have to have something other than just quality food. You have to have the atmosphere. You have to have that guest service. We don't call the people that come into our restaurant customers. We call them guests, because we really believe that they're coming into our dining room at our home. When you order at the POS station, we don't give you a number, we take your name. So it may sound a little bit goofy, but it's a little bit different personalization. So then when we walk the food out to your table, we say, Pat, double cheeseburger, not number 21, number 27. Mm-hmm. So it just makes you feel a little bit better as a guest. And then if you walk in and that person behind the POS system remembers your name, or maybe they remember that you get a bacon double cheeseburger all the time and an Oreo milkshake, and they say that, and you're in with somebody and they catch your name, or hey, you're getting that thing, that same order, makes you feel like a king as the guest. So that's how you have to differentiate yourself today in the market. We know we have a great burger. We know we have great hand-dipped milkshakes made the old-fashioned way in a metal tin, spun, not pulled out of a machine. So we know we have quality food. It's that other atmosphere and that sense of nostalgia that's going to set us apart.
You're a franchise guy.
Yes.
That's
all my life.
Your whole life, yeah, your whole career. What's the franchise model here?
In terms of?
So how does it work? I mean, are these all independently owned and operated? Are they company stores?
No, we're 100% franchised.
Okay, 100% franchise. So an asset-light model for you on the corporate side. How do fees work?
The
franchise fees.
Initial franchise fee, the license to open up a restaurant, is $35,000.
Okay.
Your ongoing royalties are 5%, and the advertising fee is 4%.
That's pretty typical to the industry.
Correct.
So all you need is $35,000 up front in order to do it, plus the capex that you need to build out your location.
Yeah, the total investment is between $550 to $650.
Okay.
Including the franchise.
How do you explain the footprint where restaurants are right now in the U.S.? Is that because of who you found as franchisees? Is that deliberate? It's definitely, there are a lot, but they're concentrated in certain areas.
Yeah, we concentrate, except for the one that we're doing in Manhattan. We started in 1991 in Newark, Delaware. We've always been very successful in small towns. We are opening up the one in Manhattan, opening up one in New Orleans. So those are really our first forays into downtown areas. And we've been successful, but now through that downtown, through those small markets, now we're growing into the cities.
Who are you seeing as your typical franchisees? Are there a handful of people who have like 10 of them, or are they sort of one-offs?
No, we're a little bit different than some other franchise companies. We look to award one franchise at a time, where many other companies want you to come in and do 5 or 10 or take down a whole county. We want to be in business with you first, see how you do, see if you're happy with us, we're happy with you. We're all about growth, but we want to make sure we're growing with the right people. So we do one at a time.
Does that mean you do have some franchise operators who have more than one?
So now over those years since we've been franchising, since 2008, we're about 45% of our system are multi-unit franchisees. So they've reinvested in the brand and themselves. They know that it's working and they're happy and we're happy with them.
And you do stuff over internationally too, like Brunei, Ireland, South Africa, Japan, Canada.
Yeah.
And you're continuing that. Like, how do you what's that model? And
that model's model's a little bit different than the franchisee in the U.S. It's done by a master franchisee, and that person or that company actually becomes really the parent company in that country or that territory or that province. So they have to do everything that we do in the U.S.
Interesting. How quickly does somebody who sets up a restaurant, a franchise, and how quickly do they get their money back?
Really depends upon how they set up. If they're an owner-operator and they're taking a salary, or if they're multi-unit owners, it's a different payback and how they set it up financially, whether they're paying all cash for it, using their own money, or if they're going to the SBA or a lending institution for financing.
Is the model such that the franchisee is actually in the back working, getting his or her hands dirty?
No.
Does that need to happen? There's some chains are notorious for that.
They need to know. Yes, they need. When you become a franchisee, you're going to have to learn how to flip burgers and drop fries and make milkshakes. The reason being, not that that's going to be your function as a franchisee. Your function is to grow your business and to get a new guest every day. But you need to know, because when you walk in or when you look on a videotape and you see that the side of the floor is dirty because they've been hitting it with the mop and not cleaning that, you need to walk in and be able to catch that. So you need to go through the full training process. But no, we don't expect our franchisees to be in behind the grill every day. That would be a waste of their talent and their training.
We got about 30, 40 seconds, and then we're going to take a break and come back and talk some more. Do most franchisees work out, or are there a small percentage where it's just obvious? Because you got to worry about the brand, the reputation. One bad one can bring it down. So I'm just curious, do most of them, like 90% of them, work out?
Most of them, yes, they do work out, and we have a great family of franchisees across the U.S. and across the world. Yeah, there are some times where people either decide this isn't for them, or it is a lot of work. The restaurant business is a lot of work.
Yeah.
And you also have to have a personality to be in the restaurant business. It's not, you're not behind a desk. You have to be, out there, front man. And if that's not for you, then you shouldn't get into the restaurant business.
Pat, talk to us about some of the logistics of, as Tim rightly pointed out, it's franchisees, so asset light. But I am curious about food costs, labor costs, building out in, as you said, you're getting ready to open up or have one location in New York City. It's expensive here in New York City. Talk to us about some of these dynamics.
Yeah, well, the food cost is, again, one of the reasons you get into a franchise model is we go out and we negotiate for 150 restaurants for beef, for buns, for ice cream, for soda, for all the supplies. So you're not, if you were going out and just negotiating for yourself, you wouldn't get that volume discount purchase. It also talks to the quality of the product because we're getting the quality, the consistency. So you get that same burger, the McDonald's theory, whether you go to one in California or whether you come to one in New York or Florida, you get that same taste. Same thing with Wayback. It is the same product across the U.S. So you get the volume discount in the pricing. You get the same quality and the consistency which the guest is looking for when they walk into a Wayback or any franchise model. And I forgot what the other part of your question was.
Labor costs.
Labor costs.
And even overhead of building out. It's not going to probably cost the same to build in New York versus maybe somewhere else across the United States. Or does it? I don't know.
No, New York City is a different animal to itself, but it was an existing restaurant, so those are some of the spaces that we look for around the country, as long as it can't compromise on the quality of the location. It has to be a number one location, AAA location, and if it was a restaurant location, great. You don't want to take a second generation restaurant that went out of business because it was a bad location, but it's going to save you $50,000 in build out costs.
So you do research. You're like, okay, who was here beforehand, right?
Yeah, and why did they go out of business? Is it in the back end of the shopping center? Was it a bad shopping center? Can you make a left-hand turn? Is there a light to get in, to get out? Or are you taking your life in your hands if you have to pull your car out of that shopping center? So we do all that research along with our broker networks. We have a real estate platform, a modeling platform that looks at the locations that we're choosing with the franchisees. And we hold their hand all the way through that. You asked earlier what type of people are coming into the system. It really spans the horizon. There are restaurant people that come in. There are people that come out of corporate jobs. There are people that come out of IT. It's really all across the board. But we have the training programs and the systems to be able to make them successful.
Okay, lots of questions here. You mentioned labor.
Yeah.
Yeah, I want to hone on that a little bit because we've seen labor costs over the last few years go up quite a bit. It's been tough in some markets, even finding the labor. What's the labor picture you're hearing from franchisees right now?
One of our franchisees told me about 6 months ago that I said, and our first franchisee opened up in Utah about a year ago. And I asked him, is there any labor problems, labor issues, finding labor in your market? And he said, Pat, there's no labor issues. It's you have to pay what the going rate is in the area. And that's really what it comes down to. If a restaurant down the street is paying 25 cents more an hour than what you're offering, you're going to have a labor problem. Minimum wage is a fictitious number. There is no minimum
because the
wage.
market determines that.
Correct.
We found. But if, let's say, you're a franchisee in a part of Utah where the cost of living is higher, has to pay a higher wage than somebody based in, let's say, a Sunbelt state where you have a store, where the cost of living is lower, is that reflected in the actual menu price too? Do they have discrepancies, or do they have the ability to have discrepancies within menu pricing?
Absolutely. We don't force them to charge X amount for a burger or a milkshake. Labor has to be taken into account, just like rent has to be taken into account. The rent in New York City is going to be much different than the rent in North Carolina. That has to go into the menu prices. The food cost goes into the menu prices. We were talking earlier about the price of beef and the price of proteins and how that has gone up over the last 3-4 years. So that has to be accounted for, and you see that in menu prices and inflation and things of that nature.
I was looking at the menu. The menu looks great, by the way. It got to a part though where it had the non-meat burgers. Yep. Carol and I used to talk about these all the time.
Now it
Does anyone order these anymore?
That's a great question.
They still do. The Impossible.
The Impossible,
the
plant-based.
Yeah, the plant-based. We carry the Impossible Burger. And probably 3-4, just right around the pandemic is when we brought it on.
That's when it was hot.
Yes, and it probably went up a couple of years after that. It's funny, we had it on as a limited time offer just before the pandemic hit, and we weren't sure how it was going to go. And it was also going to be an expensive menu item because that product was an expensive item to bring into the restaurants. And it turned out to sell very well. And we took it off because we had a limited amount of supply of it, and never saw so many feedbacks 4 or 5 years ago. When are you bringing that back? The only reason I came into a burger place was I saw that you had that online. Now that has definitely waned, and the plant-based meat alternatives have gone down somewhat.
It's so I don't know about you, Carol, but I went from I loved those things, and then I kind of realized what was in them. And
I was never a fan.
For me, now I'm like, give me the cow.
Yes. I was never.
Give me the cow.
No, because I thought the amount of salt that was in it, and I had so many conversations with folks that were in the industry, and I'm like, I should be your customer, but it isn't a healthier option.
Yeah, we have. Well, it's
At least
really
for me.
it's really for people who are not they're not vegetarians. They like meat. They like the taste of meat. They were looking to cut down their consumption of meat and going that way. So it worked well for us.
So I'm looking at a sweet bacon burger that's just oozing with bacon and cheese. Looks kind of yummy. Cheese fries. Yep, give me some fries.
Get the bacon on the fries.
I'm just saying, what happened to people wanting healthier fare?
I think this is looked at as healthy now.
Come on. No, to be fair,
we gotta ask RFK what's healthy.
We've only got about 30 seconds. Like what
people looking, and they want to eat healthy in January when they get their gym membership, and when the calendar changes. Come February, everybody's back to eating those 2-3 burgers a week.
Sorry, go ahead.
Or 2.5 burgers per day.
2.7.
I'll take the 2.7.
I'm just saying. Pat Collins still with us, president of Wayback Burgers, Bloomberg Interactive Broker Studio. First of all, private equity money that keeps getting involved into different worlds, good or bad?
Some of it's good, some of it's probably not good. We're very much we're not private equity. We're owned by 2 partners, and no debt on the company.
Which own what?
They're the franchise. We're the franchisor.
So they own the concept?
Jake's franchising.
They own the concept.
Yeah.
Yes. Okay.
They own the franchising company is called Jake's Franchising, and we're the parent company for Wayback Burgers.
What'd you think of the Jersey Mike's purchase?
Blackstone buying it.
$8 billion.
Yeah.
Huge amount of money. But we'll see what happens. That's what the valuation, if you look at it per location, is pretty high.
So did Steve Schwartzman overpay?
I don't know. I guess we'll see in the years to come.
The business, I think about margins. How tight is it in a restaurant? What are the margins like?
It's tight. You have to watch your food cost. I mean, our burgers. I think you were asking what's changed over the years.
1991, you guys started, right?
So it started originally in Delaware, but when the beef came in, it came in bulk. And you had to roll, they called it rolling burgers. Mm-hmm. So you rolled them into little meatballs because it was all fresh burgers. So you did that in the back of the house, and you had to weigh each meatball burger before we pressed it. And the problem with that is
kind of like my mom did, but she kind of just
right. What you did at home, except your mom didn't put it on a scale.
No, she didn't.
And if one was bigger than the other, it didn't make a difference at home.
Yeah, my brothers got those, and I got the smaller burger.
In the restaurant industry, again, you want consistency, but the problem is if that burger goes out bigger, then it's costing you more as a franchisee. If it goes out smaller, then the guest is not getting the right value.
Tim is ticked off that his burger's small.
That's right. So we went to our burger supplier after years of doing it, and it was a labor issue, rolling beef, and nobody wanted to do it, and it was the employees didn't like doing it. So we went to our beef supplier and said, and quite frankly, it was a food safety issue having hands on it, and we went to our manufacturer and said, is there a better way? And they said, yeah, you know what, we've just started doing this where we can make your proprietary beef in a loosely formed puck, they call it, and at your weight, your specifications, and it'll come into you cryovac, and each patty is already done. So you take it out of the back of the house. So that's a labor savings. It's a food cost savings because now it
costs you a little bit more, though, right?
No, it costs the same amount of money.
Really?
They'll just pre-measure it for you.
They pre-measure it. It saved us a lot of money. Yeah.
Wow.
And now there's, the team members loved it because, and the franchisees loved it because you're getting people out of the back of the house. So you're better able to serve guests in the restaurant. Mm-hmm. Same thing with our ice cream. We hand scoop the milkshakes, and the ice cream that we used to use was a vanilla bean ice cream. it sounds funny, very, very hard, even though it's frozen at the same amount, and nobody wanted to do it. You had to take the tub of ice cream out and sit it on the counter in the back for a little while, let it thaw out a little before the team member could scoop it. And you were scooping hard ice cream. It was tough.
I think about that with folks who are doing ice cream. It's a lot of work.
It is.
I'm getting some questions.
So what were you going to say? Did you automate it?
So we were eventually looking at that, but we went back to the ice cream guy and he said, we can make an ice cream with a little more sugar content, and believe it or not, it's softer. It's still at 10 below zero, but it's softer. You can take that out at 10 below and you can scoop it, and you can almost scoop it to order.
Okay, we only have a couple minutes left, but I'm getting some questions from folks listening and watching right now. As the person who's the president of the franchising firm, do you have a view on unionization at all? We're seeing it happen at places like Starbucks, for example, Apple Store. Yeah.
Look, I mean, we're in the hospitality business and the restaurant business, and we want to make we're also 100% franchised, so it's a little bit different than Starbucks, where they're all company-owned units. So we want to make our team members, we want them to be fairly paid. I don't know whether we would take a stance one way or another on unionization.
All right, so if we're coming, is Tim a garden burger? Is he a Carolina? No. Is he a Cajun? I know I'm an A1 steakhouse.
Yeah. I mean, I would do any of the above. I was looking at the menu earlier.
Well, also look at the cheesy, which is very plain, but it's 4 slices of American cheese on a double patty burger with an inverted butter bun.
That's magical.
Yes.
No offense, I've done that with hot dogs and buttered buns.
It's a grilled cheese with a hamburger in the middle of it.
Okay. Only 30 seconds. Technology. Kiosks in stores. What's going on?
Kiosks in stores. We started, again, that came out of the pandemic. We have about 50 restaurants across the U.S. today that have the kiosk. Every new restaurant that's being built with kiosks. It's not so much of a labor savings, but redeploying the labor in the restaurants so that they can better serve the guests.
5 seconds. Consumer doing okay?
Yeah. Consumer or
consumer? Shopper, yeah.
Shoppers doing
restaurant
okay?
Person who comes to a restaurant, you think they're doing okay? They're not pulling back or anything?
No. I mean, we see that our sales haven't slipped. So
good stuff.
Knock wood.
All right. Well, when New York opens, come on back.
Definitely.
All right.
We'll meet you there for a burger.
Deal. Pat Conlon, president of Wayback Burgers. Thank you so much. Really enjoyed it.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business App, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Before we wrap up our broadcast, we want to unwrap some data from the PNC Christmas Price Index. Now in its 41st year, PNC has been keeping track of just how much the 12 days of Christmas cost. And spoiler alert, it's a lot.
Inflation is to blame for the rising costs of decking the halls. Kind of. I mean, yes, it's a little complicated, though. We dive into it with Amanda Agati, Chief Investment Officer at PNC Asset Management Group, who broke it all down for us.
The Christmas price index is up really significantly. And thankfully, my favorite gift in the index, the golden rings, of course, is not the driver, as you said. It's really the services side of the equation, which we equate very much to the performers. That's really what's driving this year's calculation in terms of the Christmas price index. And also interesting, very much still a lot of services inflationary fire in the broader economy, too. So the numbers may look eye-popping, but the trends are actually quite similar.
But I don't understand the gold element here, because gold is up 30% from a year ago. But in your analysis, it's exactly flat from a year ago.
It's not just purely about the cost of the gold itself. It's the production and the creation of the ring. And so every year we go back to the same jewelry store and talk to them about their prices, and they have not raised prices on a year-over-year basis. So their margin is certainly coming down because the input cost has gone up, as you said, but they haven't moved the needle in terms of the price for the ring in total itself. And that's a nuance, but notable, I think.
So wait, the trends remind me, over the years, as we have talked to you about this, as we are a service-led economy, has it increasingly been that the service side of the 12 days of Christmas is what kind of moves the needle when it comes to costs?
It hasn't always been the case, but as the broader economy has shifted from goods to more services, we've actually seen a similar trend. The Christmas price index isn't leading it necessarily, but we are seeing that shift in the underlying data and the calculation of the index. And so when you look at the performers in particular, I mean, think about it, the Taylor Swift effect, the Beyonce effect, we're going to pay anything to get our hands on those tickets. And so the performers in the index are really garnering their big fair share of increases on a year-over-year basis.
See, and I was thinking the 12 Ladies Dancing, or was it 10 Lords of Leaping? 10 Lords of Leaping?
10 Lords of Leaping.
They were doing backup work, for Taylor Swift, so could have driven up the cost that way.
6 geese a lamb.
One way or another, the cost is way up, and consumers will pay anything for services these days.
What's up with these 6 geese a laying, up 8.9% from a year ago? I thought poultry prices were flat or down.
It's sort of an interesting dynamic there. I have to say, the backyard farming trend, dare I say farm to table. Hopefully the geese aren't listening to me here talking to you about that. Wow, that's harsh. I know it is, isn't it?
Yikes.
These are the cold, hard analytical facts for you.
Yeah.
But there are definitely some consumer-oriented trends driving the demand for geese up relative to some of the other birds in the index. I mean, what are you going to do with turtle doves? What are you going to do with calling birds? They're not the greatest of gifts, but geese, I could get used to that.
You got to clean up after some of these gifts, which is never something that
birds are messy, man.
Was encouraged in my home.
And they fly like you can. Where it's never.
Yeah,
encouraged.
I mean, at the end of the day, I'm not sure what True Love is really thinking, buying all of these birds here, but nevertheless, we're not going to deviate from the classic holiday song. So this is what you get.
Well, this is what happened. We like to buy experiences these days, but they were more interested in things back then, Carol.
Yeah, that's so true. I had a sister who's always like giving experiences, which I always thought was a kind of a cool thing. But I do think about that, right? Experiences versus stuff. I wonder, the 8 Maids of Milking, is it raw milk? Is it?
Wow.
Are they getting?
She's got to get political here.
Are they getting political at all?
Oh boy, I'm going to plead the fifth on that one.
That could be a different cost equation. I'm just going to point that out.
It could be very different, agreed. The underlying data as it relates to the maids of milking really ties very much to the minimum wage.
Okay.
And because the minimum wage hasn't changed at all in many, many years, that one has been holding pretty steady. We could talk all day long about, the philosophical aspects of, wages and the minimum wage and where we are from an inflationary perspective. But until the minimum wage moves, from a policy perspective, that one unfortunately is holding steady.
We said the cost of all gifts crossed the $200,000 threshold for the first time last year. Today settles at 3.6% higher at $209,272. Help me understand, does this say to you, though, in general, that we are living in a little bit of an inflationary environment? Like, what does it tell you about, if we step back, about what it means in terms of the U.S. inflation picture?
Well, I think we're certainly living in an elevated inflationary environment. I mean, we're gaining on it relative to the peak of, 9% in terms of CPI that we saw sort of in the depths of the pandemic trends that we saw there. But we haven't seen prices come down. We're not in a deflationary environment. It's really just that the rate of change on inflation is slowing. And so we are seeing some elements of the Christmas price index slowing in terms of that rate of change increase, but nevertheless, things are on balance more expensive this year than they were last year, and it's just a reflection of the traditional economy as well.
Yes, Carol Massar?
What's up with the partridge in a pear tree? I mean, partridge unchanged, but my understanding is a 17.1% jump in the price for a pear tree?
That's the traditional buying. That's not the internet buying. Okay, that's the brick and mortar.
That's absolutely right. Last
is that
year
fair? Can I get some backup here, Amanda Gotti?
Yes, absolutely. Last year we were teasing that we were going to make the partridge sit on a cardboard cutout because the tree was so darn expensive to try and control for prices. We should be saying the same thing this year. But the reality with the tree is we use that as a proxy for housing costs. And even though mortgage rates are moderating in the wake of some of the Fed policy actions we've seen these last few months, demand for housing continues to be really, really strong. We're net short housing supply in this country, so house prices are really elevated, certainly just like they were last year.
So if you want to buy the entire cost of the Christmas song, if you buy it the traditional way, $209,000, up 3.6% from last year. If you want to buy it online, close to $250,000. The rate of change for inflation was lower on the internet, but more expensive overall.
Can I use Klarna to do this?
You can buy now, pay later. Yeah, you can buy now, pay later.
Which would be another sign in terms of how the economy is doing.
Amanda Agati over at PNC. Always fun when you join us, even if it is during the month of November. And we're already not even to Thanksgiving yet, but talking about Christmas. Couple days, I know.
Did you see the decorations up around?
I did. The trees are out.
It's happening. This is Bloomberg.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business App. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.